Saturday, September 8th, 2018, Monaco 64, home of alternative economics and contrarian views. Before I start this morning, I'd like to thank all the viewers, subscribers, contributors, all the donations you've made. It really helps the channel grow. As it's the weekend, I'm going to look into more detail on the world economy and what's going on and the markets. I'm going to cover the subjects of economic recessions first, and then I'll look into the property market in the UK, in Australia, in the United States, and then look at how the stock markets around the world are doing and what it's pointing to. So, yeah, Billy's here this morning. He's probably going to lie down and go to sleep soon. So let's have a look at recessions. I found a good article actually from April 2017, and it's from wiseratings.com. It's written by Mandeep Rai, a senior analyst, and it says at the time, April 2017, buckle up, the next stock market supercycle may be here. And he talks about recessions and when they occur and the duration of average duration of recessions. I'll read from the article. If you remember, a few months ago, I wrote a piece covering the history of recessions and expansions, one that said the average length of an expansion is 7.6 years. The longest, just prior to the tech wreck, which was 2001 recession, lasted about 10 years. And he goes on to say, since the last recession officially ended in June 2009, almost 8 years ago, history tells us we could be in the last few years of this expansionary bull run in the market. But whatever you do, don't go heading for the exits, because if you do, you could miss the next stock market super cycle. So that was in April 2017. And he proved to be right. Don't get out of the stock market at the moment. But one interesting thing from this article that I got is that the longest expansion lasted 10 years. And June 2019 is going to be 10 years since this expansion started. Some of you have asked me why Jim Sinclair has been mentioning June 2019. Now I think I know why. With that, I want to look into what's happening in the economies, like in the UK, Australia, and in the US. And I saw an interesting article yesterday, I think, or the day before, and I saved it. It was from Bloomberg News about the UK, or the London property market. And it says, London property, here comes the slump. And I'll read. Jitters surrounding London property market are finally starting to show up in home prices. Brexit uncertainty has converged with rising interest rates, higher sales tax, and stretched affordability. Islington is suffering the biggest declines, with home prices falling 7.8% from a year earlier, according to Bloomberg's analysts of preliminary UK Land Registry. Home prices in Wandsworth have slumped 7.2%, and those in Southwark fell 4.8%. Surveys have shown declines for several months, but now the end of the boom is clear in official statistics too. It could be a while before the full extent of the price declines show up in the numbers, as tumbling sales have made it difficult to gauge the full picture, especially in the priciest parts of central London. And then I saw another one on Bloomberg News. Again, Bloomberg. It says, rental glut sends chill through the hottest US housing markets. So in the UK as well, we have a buy to let or to rent big market in that sector, mainly because interest rates have been kept so low, and a lot of people have Instead of leaving the money in the bank, they've bought real estate or property to rent it out. A lot of these people, though, are also they've also taken on big mortgages. So what does it say here? Seattle is known for its hip neighborhoods, soaring home prices, and being home to Amazon.com Inc., the world's most valuable company. So why is the rental housing market experiencing the most severe slowdown in the U.S.? Seattle area median rents didn't budge in July after a 5% annual increase a year earlier and 10% the year before, according to Zillow data on apartments, houses, and condos. While that's the biggest decline among the top 50 largest metropolitan areas, it's part of a national trend. Rents in Nashville, Portland, and Portland, Oregon have actually started falling. In the U.S., rents were up just 0.5% in July, the smallest gain for any month since 2012. And it goes on to say this is something that we have started to see 2 years ago in New York and D.C. So there you go. UK, US, now Australia. Zero hedge. This is from the 6th of September, so a couple of days ago. Australia's big banks raise mortgage rates, sparking housing market fears. So I'll read a little bit here from this article. It says, for decades, the housing market in Australia, which has not seen a recession in 27 years, appeared immune to any external or internal shocks, as prices kept rising gingerly year after year. That all changed in the past year when, according to CoreLogic, home prices across Australia's 5 top cities peaked in October 2017 and have since declined by 3.5% on average. I want to look at some U.S. housing statistics so we can get a better picture. I'll quickly go through some indicators. First one is U.S. New home sales. You can see here that in the past boom, up until 2008, U.S. home sales were running at 1.4 million a year, almost at the top. Then there was the collapse of 08-09 that dropped massively, and you can see that we've recovered, but nowhere near to the pace that we had in the housing boom from 2002 to 2008. We're now at just above 600,000 new home sales per year. It looks like it's topped. It's still early days, but it hasn't even recovered back to where it used to recover in the 70s and 80s, above 800,000. Next one, U.S. existing home sales. So again, back to the 08 boom, we got up to a rate of over 7 million a year. We haven't gone back to any level near there, and it seems to be topping right now as well. So that's U.S. existing home sales. Another one is to do more with financing, housing, and it's called U.S. Mortgage Refinance Index. And I'll read a little bit here what it exactly measures. Mortgage Bankers Association of America, that's MBA. The Refinance Index covers all mortgage applications to refinance on existing mortgage. It is the best overall gauge of mortgage refinance activity. So usually you refinance when interest rates are going down, when house prices are going up, and you might want to take out some equity out of your house. So it's a good gauge, I think, indicator for the health of the housing market. If there's a lot of refinancing activity, and it shows you where interest rates are going and the cost of borrowing is going. So again, you can see how refinancing was huge back in the early 2000s up to 2008. After 2008, there was a lot of refinancing, I guess, because Interest rates were cut massively, so people were still refinancing. But now you can see since I would say middle of 2016, look how the trend has been down. So there's very little, the activity for refinancing is shrinking. And that, in my opinion, is not a great sign for the economy. So with all that in mind, with the fact that the average duration of booms is 7.6 years. The last recession, the Great Recession they call it, ended in June 2019. And the fact that we are almost in 2019 and June 2019 will be 10 years since the last recession, it leads us to believe that we're close to some kind of event, unless we're going to have an even bigger expansion. But I think we need to look at the past and see that there's a big probability. That's the thing. There's a big probability that we could be in the last legs of the stock market, bull market, and the last legs of economic expansion around the world. So let's look at the stock market, and I'll start with the S&P 500 index. And I've got a chart here going back 3 years. It's a weekly chart, and the article I read from earlier in the video was in April 2017. The guy who wrote the article thought we still might see the stock market rise, like towards, because we still had time in the expansion. And he was right, because we're below 2,400 and now we're at 2,871. And I just wanted to show you that earlier in the year, end of January, the S&P traded to a high of 2872.87, and that's where it closed on that week. So that was a closing high, and it was also the all-time high. And late in August, we made a new high at 2916.50. But this week, actually, you can see there by the little red bar, we came off, and we actually closed at 2871 yesterday on Friday, 2871.68, which was basically just over a point below the all-time high. So is this going to prove to be a false breakout that we had in late August? We'll have to wait and see. But at the moment, it looks like that all-time high from January hasn't held for too long. With that, I'll move to the Dow, because the Dow, as you can see here, this is more of a longer-term chart, because after the Dow, I want to look at the Shanghai, a very long-term chart there as well. But you can see as well that we made the all-time high there in January at 26,616, and in August we got up to 26,168. That was the high. But so we didn't manage to make a new high like the S&P, and usually that's a non-confirmation. That's not a good sign. I wanted to show you the Shanghai composite index, and that's going back as well 20 years. Usually don't look at China, but China is a huge economic powerhouse. It's a lot more volatile, this index, than the Dow, for example. But you can see that it pretty much kind of follows the rest of the world. You can see it made a huge, major high above 6,000 in October 20, 2007, and had a massive drop, just like all the stock markets did. And it seems to have calmed down over the years. The moves aren't as volatile as they used to be. But one thing that I've noticed is that we haven't been able to, of course, get back to the 07 high. We tried to do that in 2015, and it failed, and then it crashed again quite sharply. And for the last 2.5 years, it had been going up and had made like a kind of a medium-term high at the beginning of this year. And look what it's doing now. Of course, there's the trade wars to take into account, all the Trump, China bashing, so to speak. But China is still a huge economy, and we should, take a look at what their stock market is doing as well. And I wanted to also look, excuse me, at the European markets, because, they, over the years, I remember working in the city, in the 90s, 2000s, 2010s, and the U.S. and European stock markets were quite correlated, and recently they haven't been, because they haven't performed as well, especially the FTSE, and which is the London FT 100 index, and you can see that it actually has done quite well since the pound started dropping beginning of April. And we actually made a new high for the year in May, but now we've turned around and it's coming back down. So not looking good as well. You could say it's not confirming the S&P as well, even though some might say that you can't really compare them. But I would say historically you can. DAX is a DAX index. It's the Deutsche Aktien Index. It's the German index, and I've taken it back 5 years. And to me, Germany is one of the major economies, the powerhouse of Europe. It looks like we're forming a head and shoulder here. It did make a new high there in January 2018, just like the Dow, but it's gone nowhere near that high again this year. And you can see there's a head and shoulder forming there, and the neckline is just I would say just below 12,000, around 11,700. So DAX not looking good either. And now the French index, same kind of formation as the DAX, looks like a head and shoulder. It made a new high actually in May, a bit like the FTSE, but it's kind of failed as well. To conclude, the expansion has been almost 10 years now, and we know that the average duration of expansion is 7.6 years, and next June is going to be the 10th anniversary of this current expansion. So we are very near some kind of event in the markets, in the economy, and housing is starting to show cracks everywhere around the world. Housing is still very important to the Western economy, because it makes, the housing market's doing well. It makes homeowners feel wealthier, and they will have more confidence to borrow and spend. After all, this is still a fiat money credit driven economy. If you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on steemit.com, DTube, and on Twitter. I'll talk to you later. Take care. Bye.